open this?
Yes.
Hello and welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I'm Sunera Aarti. Today we're at the Big Umbrella Preschool and Apple Seeds India Activity Center in Mumbai, and with us are a few young mothers who want to invest for their child's future as well as their own. And advising them are perhaps two of the foremost financial advisors that we have access to. We have Ajay Bodke of Prabhudas Leeladhar, and we also have Hemant Rustagi of Wiseinvest Advisors. Thank you so much for being a part of our show and also for the continued encouragement to investor education that you've shown. Thanks very much. You know, a young mother perhaps is at the best stage in life to begin investing because she has such a long time horizon at hand. And it's also a very critical phase because this is when the responsibilities have gone up manyfold and they're never coming down. So it's very critical that all of you begin investing if you haven't already. And before we open the floor for you to ask questions to our advisors, I want to ask you to jot down how you would allocate money. So if I was to give you, say, 25,000 rupees in paper money for a month, I want you to tell me how you'd allocate it. That looks easy, and Ajay and Hemant will review them and will also judge the best asset allocation, but that's for later in this show. But before we open the floor to our young mothers here, I want to begin by asking you, Ajay, that through the series we've met with a lot of communities and we've spoken a lot about how they should be doing things, what are the products they should be choosing. I want to ask you, what is it that someone with this risk profile should not be doing?
I think someone with your risk profile certainly should look at an asset allocation plan and not put all your eggs in one basket. There is a tendency of being too risk averse at a very young age. So sort of as one ages, I think the asset allocation plan also changes with time. So I would suggest having a well-rounded, diversified asset allocation with some money going into a house, followed by some asset allocation towards equities, some fixed income securities for a regular source of income, and some gold. Also, one needs to rigorously monitor how the asset allocation plan is performing at regular intervals. One of the common pitfalls that many investors tend to have is they don't have an asset allocation, and even if they have an asset allocation plan, they do not monitor it at all. So I think these issues need to be kept in mind when one is looking at investing. And as I said, at a young age one can afford to take slightly higher risks than, say, an age group which is on the verge of retirement. And hence an asset allocation plan of a young housewife will differ with someone with a lady who's on the verge of retirement. So I think from that perspective, one should look at asset allocation.
For sure, asset allocation is something that's very, very critical for all age groups and risk profiles. But Hemant, I want to ask you that, they're probably at an age where not so long ago, all of us were spending money on going out and clothes and all of that, and now responsibilities have changed. How can investment practices then change with time and as they age?
One of the most important things is before you start investing, like I just said, you need to have a financial plan in place. But I just want to add something to the mistakes that we make generally at this age is to delay the investment process. What we need to understand is there is something called power of compounding that works the best over a longer period. So the more time you give your money to grow, the more you benefit in terms of returns that you get. So don't delay that. And also remember, every 10 years you delay the process, you have to invest 3 times to achieve the same amount that you would have achieved if you started investing 10 years ago. The second important thing is we don't give due importance to risk management. Okay, what is risk management? That's basically ensuring that we have adequate risk cover. And what is the risk cover basically we need? We need risk cover for life, we need risk cover for health, and also for our property. And the best way is, don't start investing haphazardly. Okay, today equity market is doing very well. Let me put my money in equity market. For the last couple of years, equity market is not doing very well. Let's put our money in bonds because that is where the money is coming. That is not the right way. The simple way is to establish your goals. Okay, all of us have goals that we want to achieve in short term, medium term, long term. Once you do that, assign a time horizon to each one of them. For example, we know that, okay, we'll need money for our children's education after 15 years. So the time horizon is 15 years. We need money, let's say, after another 5 years for their marriage, or rather after 30 years for the retirement. So assign a time horizon for each one of them, and also set a target. And whenever you're setting a target, remember that take inflation into consideration. So I think these are simple steps that we need to take. And once you do this process, what happens is automatically you can decide your asset allocation. Asset allocation is basically a strategy whereby we decide how much money should go into different asset classes, whether it should go into gold or whether it should go to debt or equity. I'm talking about the financial assets. Now, we need to also understand the risk. What is the risk that we have? Whenever we talk about risk, the only risk we think of is losing our capital. But there is another bigger risk that we generally tend to ignore, and that is inflation. You need to beat inflation. We all need to understand there is something called real rate of return. That is, your return minus inflation should be a positive. Otherwise, your money is just growing in numbers, not in value. There you can invest in equity. So you see, when you come with a clear time horizon in mind, even if the markets are volatile, you won't be worried. If you get into equity without a clear time horizon in mind, then you don't know what to do with it. So every time the market turns volatile, you want to just get out. So I think these are simple steps that if you start, I'm sure you can achieve all the goals that you have in your life.
All right, so it's not equity or financial products that are the real monsters, but it's inflation which is the real monster that you need to be wary of. But anyway, let's open the floor. And who has a question for experts?
If I had to invest in mutual funds, would you suggest a one-time investment, like a huge amount, or should I follow the systematic investment plan, which would benefit me more? And what kind of funds should I invest in also?
Yeah, I think one must go in for a systematic investment plan because that helps ride out the upturns and downturns in a market rather than putting money one shot in any mutual fund. Now, insofar as the kind of mutual fund that you're looking for, I would advise going in for a diversified blue chip equity fund for a first-time investor. Because as the name blue chip suggests, a company has become a blue chip by weathering the vicissitudes of the upturns and downturns in the economy. And hence, all the companies that qualify for being blue chips are the ones which will which should be able to give you steady kind of returns with the risk which is not too high, and also to go in with those mutual funds that have a proven track record over a medium to long term. And when I say medium to long term, I mean 3 to 5 to 10 years, how their funds have performed and what kind of governance practices those funds have.
Yeah, and don't get disheartened when markets are low, because that's perhaps when you'd maximize your investment. But let's take a quick break on that note. We'll be back in just a bit, and we'll continue chatting with our experts. Stay with us. Welcome back. You're watching Informed Investor. So far, we've been talking about asset allocation, discipline while investing in markets, and also the magic of compounding. In fact, research shows that if you were to begin investing 5,000 rupees a month, say today, for the next 30 odd years or so, you'd yield a compounded return of 2.7 crores. If you were to delay that investment by, say, just 5 years, your corpus at the end of those 30 years would only be about 1.3 odd crores. So that's the magic of compounding, and that's the incentive to begin investing as early as possible. And that's also something that Hemant would agree with and advise. So let's go ahead. What are the other questions that you have?
Well, the focus right now in our lives is, of course, children's fund that we'd want to invest in. And with payouts as often as every 4 years or during their college plan, the college fund, what is the best manner of achieving the most important aspect of how would we be able to bring out those payouts as easily as possible?
Okay, so first initial stage, you should be focusing on an asset class which can help you in terms of getting higher returns.
Okay.
And because you will be accumulating over a period of time, investing in a disciplined manner, the risk of volatility which exists in the marketplace, which is a natural phenomenon, is automatically taken care of. You do have other options of, you have this children plan from insurance companies, but they generally invest in a very conservative manner. So if you have a time horizon of, let's say, 15 years or thereabout, you need to accumulate as much as possible. And there, I think the best asset class is equity. So what you do is you first focus on accumulating that money. And once you reach a stage thereafter, because equity is very tax efficient, after 1 year, whatever gains you have, they all become tax-free. So depending on your needs, or what you can do, another option is, let's say if you have a time horizon of 15 years, after completion of 14 years, you take out money from equity and invest into debt-related products, so that all the gains that you accumulated over the next 14 years are all preserved. From there, you can start withdrawing money and then use it as and when you require for your child education.
All right. Anyone else with questions?
Should I keep investing monthly, or should I collect a big amount and put it all together? Or is there something what I can keep putting the money in, monthly?
No, there is no need for you to wait for a big lump sum. You can start even with as low as 5,000 rupees or even kind of an amount on a monthly basis. There's no need for you to wait, to accumulate a large amount.
What should I, where do I put it?
Yeah.
As an idea, what should I do with it?
Yeah, so as I said, I think, one could look at investing in through mutual funds in an equity plan. One can go in for a systematic investment plan, wherein whatever time horizon one has in mind of 5 years or 10 years of investments, one can keep on investing every month or every quarter the set amount. And as I said in answer to the previous query, I think being disciplined investor and being regular, one can ride out the ups and downs in the market.
Anyone else?
And what do you think about all these Jeevan Asha, Jeevan Anand policies? Like, I've done Jeevan Anand with my daughter. So, I just want to know, okay, is it like a good thing that I put my money into, or there are better opportunities where I could put my money into,
See, this is an insurance plan. What we need to understand, why do we take insurance? To do risk cover. So these plans that you're talking about basically are endowment plans. These are more of investment than insurance. These are all plans which are going to give you a return of 6, 7, 8% max. Now, if you're investing in these plans for the next, let's say, 10, 15 years, and if inflation is going to be rising at, let's say, 7%, and your return is going to be 7 or even 6%, at the end of the day, what has happened? You haven't got anything. So what we need to understand is we need to separate our investment needs from insurance needs. Insurance should be pure risk cover. For that, you should go with a term plan. Now, what this term plan does is basically it's very cheap one, and it can give you, high risk cover, which is what you need. And for investment, go into options like mutual funds, which are more tax efficient and also have the potential to give you higher return. So do a combination of term plan and investment in mutual funds, rather than going into very, very conservative investment.
Also, perhaps calculate that whether the gains from tax saving and the losses from not accounting for inflation are matched, and whether it's a positive at the end of it. But let's get into more questions.
Where do you see the rupee dollar stabilizing at? Because it used to be 45 and now it's 55. So where do you...
Over the last 1 year, we have seen that the economic growth rate in India has come down. We've seen the foreign flows have become slowed down in India. Inflation has been stubbornly high and sticky, and it's been difficult, for the Reserve Bank of India to lower rates because of inflation being sticky. And these factors all have been responsible for the steep fall in the rupee that one has seen. However, I think the government has been cognizant of the fact that the rupee has fallen, and it is taking steps to ensure that the investment cycle, which has basically come to a halt, I think it is revved up again, and it is putting in place policies to revive growth, and it is then expected that the foreign investors should take a cue and sort of should start coming back to India in large numbers. So these measures, in our view, will help revive the sentiment for the economy, as well as on the rupee front. One can see the rupee strengthening from the current levels. So from levels of 55, one should not be surprised if the rupee were to go back to a level of 52 to 53 over the next 3 to 6 months.
So 45 is totally out of the question right now?
Yes, I think so.
That's too optimistic perhaps. But let's take a very quick break. We'll be back in just a bit. On the other side, we're going to tell you how to rectify your asset allocation and your portfolio. Stay with us. Welcome back. You're watching Informed Investor, and today we're sitting with some young manders, and our endeavor has been to help them manage their money and investments better. Well, perhaps one of the biggest lessons that an investor needs to know is how to structure their portfolios and what kind of asset allocation suits their risk profile. So we get a lot of portfolios on our website, moneycontrol.com, and Hemant today has selected one of the portfolios that's in most dire need of repair, and he's going to tell us what's wrong with the portfolio and how it can be rectified.
Sure. Actually, I've selected a portfolio of Neeraj Kachoj. He's 34 years old. Basically, he wants to invest some money. He has identified some goals. His goals are like he wants to invest for his son's education, marriage, and his own retirement. Now, why it requires attention immediately is, the most important thing in a financial plan is to establish your goals and also have a time horizon in place and also set a target. While he has done the first part all right, he hasn't basically set a target, how much he needs to invest for each one of these, and also the time horizon, which is absolutely necessary, because based on these two factors, you decide what is the asset allocation you're going to have in the portfolio. So I'm going to help him out basically in terms of, because he's mentioned that he's 34 years old and he has a son who is 3-year-old. So I'm assuming that for his son's education, he will need money after 15 years, and assuming that he needs around 30 lakh rupees. And because their time horizon for all the three goals is 15 year plus, I'm recommending that he should be investing this money into equity fund through a systematic investment plan. So if he has a target of 30 lakhs, he needs to invest 4,000 rupees, assuming an annualized return of 12% to achieve the first goal. The second goal here for him is basically for son's marriage, which is a time horizon is around 23 years. And assuming that he has a target of 20 lakhs, he needs to invest around 1,500 rupees per month. For his own retirement, if the target is say around 1 crore and the time horizon is 26 years, he needs to invest around 5,000 rupees to achieve the goal of 1,000. In all, he needs to invest 10,500, whereas he had mentioned that he can invest only 3,000 rupees. Now, the key for him is to start investing. He should not wait till the time when he can invest 10,500, because then he will not get the impact of power of compounding the way he would get now. So I believe that he should prioritize his goals, maybe start investing for his son's education first, and then for other goals he can start investing as and when he has extra money to do. But before doing, starting his investment process, I would like him to, focus on the risk management too, which means that he must ensure that he is adequately insured in terms of life insurance and health insurance. And he also needs to create an emergency reserve, which should be equivalent to 3 to 6 months of his monthly expenses. The whole idea is that if you have an emergency fund, in case you need money, you will not disturb your long-term investment. For life insurance, he should go, because he's young, 34 years old, he should go for a term plan, and which should be, thumb rule is equivalent to his 10 years of income. And for health insurance, he should opt for a family floater plan, because he's a young family. So I believe that if he does this process, he starts this process immediately, he can definitely achieve his goal.
And then talking of portfolios and asset allocations, our audience had divided the 25,000 into various asset categories. You've gone through it, so it's the consensus who has the best asset allocation.
Well, I would say that Jasmine Shah, because she has allocated it over different asset classes. She has sort of looked at investing a fifth of the investments in mutual funds through an SIP, a fifth of the investments in gold, a fifth of investments in fixed deposits, which will ensure a regular income, 5,000 rupees investments directly in equities, and the rest 5,000 in a child policy. So I think, I would go sort of, with Jasmine Shah.
And any, so you're well on your way to being an informed investor. But any trends that you might have noticed in terms of the way money is being allocated?
Yeah, I think two trends I've noticed. I think there have been a couple of participants who have put all their eggs in one basket and invested only in fixed deposits. Now, we have discussed how we need to have a plan which is able to comfortably beat inflation. And if you were to invest all your funds in a fixed deposit plan, then I think, you can't expect to beat inflation. The second trend I have noticed is that some people have put disproportionate amount of money in an asset which is currently doing well. This is what I call a recency effect. An asset that has done well recently, you tend to put a lot of money in out there. And that's why around 80% of the money has been put in by someone only in gold and silver. Now, it's not possible that the asset class that has done well over the last few years will continue to give you supernormal returns over a very long term, and hence you must allocate assets over a wide range of asset classes.
Fantastic. And I hope that the show has been of help to our audience members here, and I also hope that it's been of some help to those who are watching on TV. So here's where we'll wrap up then. Thanks so much, Ajay and Hemant, for taking the time out to be a part of this show and for encouraging investor education.
Thank you.
Well, do remember to keep sending us your comments, questions and queries. We'll try to take up as many of them as we can on our show, and we'll see you here next weekend. Bye-bye.